The euro took another leg lower this morning after Italy's mixed debt auction. Borrowing costs fell, but demand was a bit lackluster. The European Central Bank is said to have been a buyer, but it won't say so officially. Joining me from Philadelphia to talk about Europe and bonds is one of the most accurate strategists on interest rates, Bloomberg best Guy LeBas of Janney, Montgomery Scott. Good morning, Guy.
Good morning. Thanks for having me.
Well, let's talk about this debt auction, because on the face of it, it looked okay, right? Borrowing costs actually came down. There was certainly a better reception for 6-month bills yesterday, but there was demand for the longer-term debt today, just not as much as had been anticipated. What's the driving force here? Because we're hearing that domestic banks were buyers.
Yeah, domestic banks appear to have been buyers, and there's kind of some interesting conundrums going on with regard to the Eurozone, the ECB, and sort of policymakers right now. And the biggest one of those is that the ECB is providing a tremendous amount of liquidity to banks. And these banks need to invest that in the short term. Yet capital rules essentially treat government debt, no matter whether it's AAA rated government debt or single A in the case of Italy, as largely the same for banks. So banks have this tremendous incentive right now to borrow from the ECB via these funding vehicles, invest the proceeds in short-term government debt of the highest yielding governments in Europe, which includes Italy. So that created a strong demand for the auction yesterday morning, and a little bit less so today for the longer-term auction.
Perhaps an unintended effect of everything that's been going on out of Europe. Is this something we'll continue to see in the new year?
Absolutely, and I think that the worries or the concerns about unintended consequences arising from what is relatively unprecedented policy action is very, very significant. Well, the problem and almost the definition of unintended consequences is that we cannot effectively predict them. So I think we'll see some unexpected similar moves, although it's almost impossible to determine exactly what those will be. In the case of Italy, it looks like a yield curve that's steepening out, sort of mixed demand. In the case of Spain, it could be something very different.
Why is that? Why would it be different for a country like Spain?
Well, again, it comes down to the whole concept of unintended consequences. Essentially, policy action that supports Italy, or even based on the presumption that Italy is simply too large to be able to default on their debt, whereas Spain doesn't have that same size problem, could adjust sort of the credit spreads priced into the Spanish yield curve in a different way than those that are priced into the Italian yield curve.
Gotcha. Okay, we're also seeing yields come up a little bit this morning in the U.S. Treasury market as well. So there is some selling because of the better than expected economic data, but certainly a lot of people before the second half of this year had predicted yields would go a lot higher by the end of this year, and here we are below 2%. People are now projecting, according to Bloomberg, that the 10-year yield will hit 2.67% by the end of next year. Why are people always predicting that yields are going to continue rising when you know that this European sovereign debt crisis is not going to be resolved within that time?
Well, I think there's sort of a resistance in terms of belief that the current low level of yields here in the U.S. can sustain. And really, we have to look at the situation and ask ourselves, all right, it's not enough to say simply that yields are too low, they must rise. We have to understand why they would rise. And one reason would be a resolution of the overseas debt problems. We don't believe that's going to happen all that effectively in 2012. Another reason would be inflation. And if the last 2 years have shown us anything, it's that inflation has remained relatively moderate in this post-recession period. And so when we take a look at these two factors, sort of deep stress globally and low inflation, that doesn't provide a lot of reason for interest rates to rise. So I think a lot of the forecasts are based on more inertia rather than sort of fundamental expectations.
Gotcha. All right, talk to us about corporate bonds and demand for that, because everyone's searching for yield with the 10-year below 2% and with so many unresolved issues in Europe. What kind of demand will you see for high yields in the new year?
Well, I think we're actually going to see fairly improved demand, very specifically for the non-financial components of the high yield and investment grade credit sector. So I bring up the idea of non-financials for a really big reason, which is to say that financial firms, be they banks or other large institutions here in the U.S., have a direct connection to challenges in Europe and problems with the liquidity of the banking system. When you look at, say, a U.S.-based industrial firm, those connections between that firm and the European banking system are a lot more tenuous. They're a lot less significant. And so we really like, and we believe demand will return in 2012 for these industrial, consumer, non-financial, high-yield, and even lower-rated investment-grade corporate bonds. So we look for a pretty good year for the credit sector for 2012.
All right. Thank you so much for joining us this morning. Guy LeBas of Janney, Montgomery Scott, joining us from Philadelphia.